How do you know if you're overextended financially? How do you really know? And how would you measure it? In today's video, I'm going to help you answer that question. And at the end of the video, we're going to be looking at some things that might help you if you think that you are. So stick around. Hi, and welcome back to the channel. For those of you new to the channel, my name is Joe Camargo. I've spent nearly 30 years in financial services. I hold an A+ rating with the Better Business Bureau. And it's issues like these that I tend to geek out on, actually. So let's get right to it. So when we start assessing our overall financial well-being, we look at two things generally. We look at our income and we look at our expenses. Most of us tend to focus on our income, and yeah, absolutely important, no doubt. But our spending habits and something called the debt-to-income ratio, or DTI, are two variables that I consider equally, if not more important. And yet, over the years, meeting with clients, I found that many of us actually struggle with our spending and generally don't even realize it. For many of us, so long as the income is solid, that's all that matters. And we end up, sadly, in what I call the more they make, the more they spend crowd, which can have a really long-lasting and negative impact on their finances. And real quick, just to kind of give you a quick bird's eye view of overall consumer spending, this chart, which I pulled in from the Federal Reserve, breaks out credit card usage on a nationwide level. And what it's suggesting, given the spike that you see at the end, is that we might be having a hard time paying our bills. It's something that I like to keep an eye on because it gives me a pretty good sense as to overall household finances and the impact that things like inflation and trade tariffs, for example, might be having on us. I thought it'd be neat to share, but let's get back to DTI. So what is DTI? What's your DTI? How do you measure it? And why is it important? To answer that, let's go a little in reverse order. In this day and age, we need access to credit. It is a simple fact of life. And our DTI, in part, establishes our ability to obtain that credit. It's a formula, a ratio, right? That's where the term debt-to-income ratio comes from. And what it does is it compares our gross monthly income to our recurring monthly debt. So if we're in need of additional credit, another credit card or loan, for example, lenders will use it to help determine whether we're maybe spending too much and as a result overextended. And they'll base their decision in part on what your DTI looks like. It doesn't include our utility, our cable, our grocery bills, for example. Those are things that are normally factor into a much more comprehensive financial assessment. And as much as I'd love to tackle that subject right now, today we'll keep things simple and stick to just DTI. So let's look at a quick example. Let's say that you make $10,000 a month. And let's say that your minimum monthly credit card payments are $400, your car loan payments are $500, and your mortgage is $2,000. If we add the three together, we get $2,900, right? And if we divide the $2,900, your debt, by the $10,000, your income, we get 0.29, which means that each month, 29% of your gross is going towards satisfying this debt that you've taken on. So the first thing that comes to mind is, well, is that good or bad? And the answer is, it depends. Generally speaking, a good rule of thumb is to keep your number somewhere south of 36%, with your mortgage payment no more than 28%, and your other recurring debt, your credit cards and your car loans, for example, to not more than 8%, giving you that magical 36% number. Now, having a score above 36% isn't necessarily a bad thing, right? Because all lenders are different. They're all going to have their own criteria. And also keep in mind that your DTI is just one variable that goes into the overall evaluation process. But again, and again, generally speaking, the further north you are of this number, the more likely lenders are going to maybe interpret that as you're having taken on too much, which might mean that you're either turned down for credit outright or you're granted credit but at a higher interest rate, and in theory costing you money in the process. On the flip side, having a score below that 36 doesn't necessarily mean that you're in good shape either. There are, and again, this might be the subject for another video, but there are a number of ways to gauge our fiscal health. This is just one. Those trips to Starbucks, McDonald's, the mall, Amazon aren't necessarily going to show up on your DTI, but they are things that can impact your monthly cash flow. So definitely things that we should be mindful of. So what if, after watching this video, you've done the math and you find that you are maybe overextended? What do? For that, look for part 2 in the series, which I'm hoping to release a week from tonight. In part 2, we'll talk about some pretty commonly accepted strategies that'll help you both lower your DTI and improve your overall fiscal health. So check back in about a week. But in the meantime, if you have any questions, message me down below in the comments section. And if you enjoyed the video and you found it at all useful, give us a like and subscribe. I really enjoy creating this content. And a new subscriber, a like, a share, helps the channel out a ton. And it keeps me motivated. Anyway, that's it for now. Enjoy your week. Till next time, be good to one another, and God bless.